Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, we'll call it 20 minutes today. We have a shortened holiday week, and today's Options Guide TV is going to be short and sweet also. Today is Monday, July 1st, 2024. The markets are open and rocking and rolling, which they will not be open on the 4th of July. So we're going to do a trade that will go away before the 4th of July. And we're going to keep our rinse and repeat strategy that we've been doing on the SPX. Basically, the outlook for the S&P 500 index and the kind of summer doldrums right here, July 1st, second half of the year, it has been neutral to bullish. I think the market's really struggling to try to go higher. We're going to start second quarter earnings reports. And, the big one, we have Goldman Sachs, I think, on July 15th. And then we're going to have a lot of the Meg 7 that we'll be announcing shortly thereafter. And then at the end of the month, we have a Fed meeting. But up until that time, a lot of times the markets are, there's really nothing. Well, I shouldn't say nothing. We obviously got economic data week in and week out that can spook the markets one direction or the other. But until we really get to the middle of the month, I do kind of expect the markets to just kind of stay in this flux period. And we've been taking advantage of that by selling or by trading at the money butterflies. Now, in my mind, that's funny that I said selling. In that, to me, it's an alternative to an iron condor, which if we did an iron condor, we'd be selling it for a net credit to the account. We're doing the butterfly in hopes of getting time decay to work for us. So on Friday's show, we did a butterfly, and it actually moved outside of the range, but I did tweet out that put the butterfly in for about $3. Now, $3 would have been a really good fill. It traded at that level during the show and when we were looking at the trade. But I doubt we would have got it filled because we did it as a paper trade. I doubt we would have got filled close to 3. Might have been 325 to 340. But if we did fill at that range, which is where I took my screenshot at, and I put in a limit order to sell at $6, and it did fill. The market, it's amazing the amount of time decay from 11 o'clock when we kick off Options Guide TV until 2 o'clock in the S&P 500 index. Now, you're talking about one-day options. Zero DTE is a better way to say it, I guess. That would be the vogue term that is being used right now. But we did it. We placed the trade Friday at 11 a.m. The trade would have filled at around 2 p.m. Eastern time and filled for around $6. So almost doubled in that short time frame. And the market actually did move away from the middle strike of the butterfly. But the time decay was so big, as long as it stayed within the range, it made that trade profitable. So for me to say we sold the butterfly is just, in my mind, that's what we're doing, because we're setting up a trade that really wants time value to decay. And but we did pay for it. And then we could have gotten out of the trade. Now, if you waited till the end of the day, the market had moved enough that it was outside of the wings. So today, as always, like to change things up just a little bit. I always like to put little tweaks in because Options Guide TV is all about learning. But it is important that you have the neutral forecast. If you don't feel like the markets will stay neutral going into the 4th of July, then you don't want to put this trade on. I mean, it's that straightforward. It all starts with your forecast. You need your forecast to be at least somewhat correct in order to usually make money with your option trades. Neutral trades are a little bit easier than obviously trying to pick a direction and try to be a winner because you got the market direction correct. So in this instance, when we looked at that butterfly, I will go back and talk a little bit about it, and then we'll come back. We'll look at the butterfly inside the options playbook, and we'll talk about the strategy just in general. and we're going to put on one more strategy in the S&P 500 index. We might even skew it a little bit to the bear side, because if anything, I feel like the market, I'm neutral to slightly bearish is the view on the market. And right now we are down about 8 points in the S&P 500 index. On a percentage basis, it's not much. And I do expect the markets to just kind of stay within this range. We're going to go a little bit wider on the butterfly. The butterfly, we've done a couple of 15-point wide butterflies, which gives you a 30-point landing range. And we've done a couple of 20-point wide butterflies, which gives you a 40-point landing range. Well, you got to obviously pay attention to the net debit that you paid, but somewhere within that range, you want that S&P 500 index to stop. Especially if I'm going a couple of days, which we're going to do. We're going to put this on Monday, and we're going to have a show on Wednesday. So we'll be able to come back and have a trade to discuss on Wednesday on Options Guide TV before we get into the weekend. And we're going to go wider. It also means we got to pay a little bit more. Why? Because we have more upside if we go wider. If you go 20 points wide or 25 points wide, you end up having that as your upside potential, right? So let's use a 20-point example. The maximum that a butterfly could trade for is the width between the spreads. And if the width between the spreads are 20 points, that means it could trade for $2,000 for a 1x2x1 butterfly, or trade for 20 times 100, which would be $2,000. So if you go 25 points, well, then it could be $2,500. If you have more upside on the trade, it's going to cost you more to get into the trade. And we'll look at that dynamic and talk a little bit about that one also. So if we go back and we look at Friday's show, Friday, last month in June, last trading day in June, that would have been the 28th was that Friday. So if we look at the 28th here, let's go to the Trader Pro software, if we can. And if we look at this trade, and I'm going to zoom in a little bit on it, the market is hanging right about where we were last week, which makes it a little tough sometimes to zoom in. Let's go look at this. Okay. So here's the range of the market. And we did have a nice solid range. When we put the trade on, where we wanted the market to go is around 45.95. Okay. So 45.95. So the range here was on the high end. We closed on the low end, but it is 55.23 all the way down to 54. Let's call it 54.50. So it wasn't a huge move in either direction, and not a lot of volume was spent here on the upside of the trade, but 54.95 is somewhere right within this range. When we closed out the trade and sold it, the market was at the end of the day, and it was trading somewhere right around here, 54.84. That's about where we closed the trade out. So 84, we were about, it looks like we did 15 points wide, and we were about 10 points away from the middle strike when we were able to close it out and get a doubler on that trade. So let's back out here a little bit, and we're going to run over to the options playbook, and we're just going to talk a little bit about the butterfly strategy. So let me pull up options playbook 1 second here. And if you didn't know this, but the Options Playbook is the book that I have written, and I own the company now called Options Playbook Incorporated. And we've got a new look and feel on the website, and a new way to find and search for strategies. But what we're doing as far as the strategies are concerned is our butterfly trades, and we're looking at the standard butterfly trade with a call option. And we've been staying on the call side of things. I like to keep things as simple as possible when we're looking at calls. So, okay, now we have that up, and we do have it up over here. Here's the setup. You're going to buy buy a call at strike A, sell 2 at strike B, and buy 1 at strike C on the butterfly. So you want the market to stay within the strikes, and this is what I was talking about when I said that the width of the strikes are 20 points wide, and that would be from strike A to strike B, 20 points wide, and from strike B to strike C, that would be 20 points wide. Um, the wider we get, the more upside we have, but the more money that we have to put on to start with. And when we're doing these short term butterflies, we're keeping the stock right around strike B, right around where the current marketplace is at. Now, if you skew it a little bit to the downside, instead of buying the most or selling the most at the money option contract on your butterfly, well, then you'd be a little bit bearish. And I actually would use put options instead of call options if I wanted to go that way. And also true on the upside. Now, sometimes you could center it around strike C, go all the way up if you are a little bit bullish on it, and give yourself a wider place for it to land on the upside. But you would need the market to actually move to the upside. Our view is more neutral in the marketplace, and we're using this butterfly with call options as an alternative to doing an iron condor, something where we want the market to stay within the range. So here's what an iron condor would look like. Let me scroll down and find iron condor in here. So inside the playbook, this is what an iron condor would look like. And we have the graphic that's kind of showing you how it changes over time. But within the iron condor, and let me stop the graphic that's growing here. Within the iron condor, you have a smaller range for it to land in. You do it for a net credit to the account, but the upside potential isn't as good, but the potential for it to land obviously within the strikes, which would be the sell of strike B and the sell of strike C. So the sell of a call, sell of the put is obviously higher. You have a higher probability of success by looking at an iron condor and selling way out of the money option contracts. All right. So let's pop back out. And now let's go in and let's set up our trade for this week before we get to Wednesday's options guide TV and review it. Okay, so here we go. Got the market right where we wanted, actually 54.60, almost to the dead center of it. We wanted to go bearish and we wanted to do the put side of thing. I would only go down maybe 5 points to 54.55. But I like that it's right at the money right now, 54.59. So instead of going 20 points wide, we're going to actually go 25 points wide in this scenario. The market is extremely flat. So the market was just down 8. Now it's down 1. So a little bit of momentum to the upside right here. We got the VIX index trading right around 13, which the high, in my mind, that's a little bit high relative to where the markets have been at recently. The VIX has been as low, down around the 12 area. Like to see it up around the 13 area if I'm doing this trade. As a matter of fact, I wouldn't mind seeing it around the 14 area. And that the more volatility that you have when you're placing the butterfly, the cheaper the butterfly will be. So if the VIX is trading at 14, or the volatility in general for the options that you're trading is higher, the butterfly, for example, might be trading for, let's call it 450. And if the VIX is trading at 12, that butterfly might be trading for $4. That's how much effect volatility can have on the cost of an at the money butterfly, even in the short term. So notice the expiration that we're using is the July 3rd expiration. It's 2 days away. So we will be buying, we're going to go 25 points. So 20 would be 40. We're going to go right here. We're going to be buying this option contract. So I'm going to click on that. And then we are going to sell the at the money contract. And we're going to be selling that twice to create our butterfly. So we are 25 points away. And so now we're going all the way up to the 85 strike, and we're buying that option contract. Oops, I hit sell. Hit buy. All right, now we're trading right for $5. We changed it up when we went to a 20-point wide. It'd probably be trading for $4 or, $3.50 and $4. Probably be about where that butterfly is at. So we're going to put out a little bit more cash, give ourselves a little bit wider range that we can land in on our butterfly and still be profitable on the trade. The maximum we can lose on the trade if we do a 1 by 2 by 1 butterfly, and that I consider that 1 unit. It goes to the floor as a unit, and we're hoping to fill close to that price at $5. So 1 by 2 by 1 butterfly for $5. That means you take 5 times 100, and it's a $500 trade for every unit that you put on. We're going to just talk about one in this scenario, and we're going to actually take this and send it to the what if calculator. And while we're doing that, I can take the time to say, if you have any questions, please go to the chat box if you're on the Tradier YouTube platform. If you're inside the Tradier hub, where you get access to all the different speakers that Tradier put together to create the hub, you can actually ask questions directly if you log in. You can ask directions that way. And if you're on x.com, we do stream live to x.com. If you're logged in, it's very simple to watch, but you can't ask questions through that platform. So there it is. There's a lot of different things that you have to attempt to a lot of things you have to explain nowadays with all the different streaming platforms. All right, so here's our position. Here is the what if calculator of it. And even though we only got a half a day today on Wednesday or on Monday, and then all day Tuesday, and then all day Wednesday. So you got 2.5 days of trading on this position. The market is right here to start with. We're very close to our middle strike. We have a fairly decent range, but if we're going to be wrong on our forecast, by the end of the day, we could make an adjustment. And you can see here by the green line, which is the profit and loss as of today, using the current volatility and everything else in our pricing model, you can see that to start with, you don't have as much risk. But as we switch days, and I can do that just by clicking on this calendar here, and we'll go to Tuesday, we won't see a ton of change in this, but you do see that the rise over run on the losing side of the trade still has adjusted a little bit. Now, if we go to Wednesday, now note this is at 11 a.m. Eastern time. So Wednesday's the last day to trade these things. Now we get a huge adjustment. Okay, so what's the moral to the story, or showing this, is that you probably got 1 day if you wanted to adjust the trade. Once you get to the last day of trading, the graph, first of all, the models kind of break down, so the profit and loss graph doesn't work as well. It's not quite as accurate. You really just need to see what's going on in the market using real numbers. But if you do get to this day, it's a little bit harder to adjust. There's just not enough time premium in to do the trade. If anything, the adjustment would be to just close it out. Say that you're starting to lose money and you're down in this range or in this range on the butterfly. Well, at that point in time, on 11 o'clock on Wednesday, I would probably just close out the trade and move on if I hadn't gotten out of the trade already. 2,500 is the maximum up here, and you can see this. You're paying 500 for the trade minus 2,500, and if you look over here, this is where it's going to show you the profit and loss, and it's going to show you that you can make approximately $2,000 if you are dead on the trade. And if you are, and you do make the maximum of the trade, you usually should receive the stupid award for that, because you should have got out of the trade. You don't just let the market just sit right at the middle strike and hope that it stays there all the way to the expiration date. That, to me, it means that I've already doubled or even tripled my profit on the trade. I don't need to just sit around and wait for the home run. Okay, so in this trade, especially if you're just doing a one lot, if you had five units on, 5 butterflies on, maybe you could leave one and let it hang. But ideally, if you're just doing one trade, if you can sell this thing for $10 or $1,000 or $15, which is feasible, right? Because you got a 25-point wide butterfly, you definitely want to get out if that case happens. Like on Friday with my position in the 1 day butterfly, put it on for 3, put a limit order in at 6, and got out of the trade at 6. And I was very happy with that doubler. It might have stuck around, but I already had a limit order in to say that if it did double, I want to be out of the trade. So I'm not going to stick around all the way to the end if that's possible or feasible to do it. Now, if you want to sit around and watch the trade all day, that's totally different. But if you're just trading to put this trade in and have a position on going into the holiday, right? Put a limit order above where you'd want to get out, get an alert on the S&P 500 index if the market goes outside of your range, and then decide if you want to adjust or close out the trade on that aspect. So I'm going to have an alert at 54.35, and I'm going to have, and I want to be note if I'm at 54.85. The market gets to those ranges, I'm going to want to do something in the short term on this trade. All right. So if you have any questions, please feel free to put them in the chat box. If not, let's go back to our trading screen. And I'll scroll down and I'll give you a quick read back on this trade. And then, so we had on Friday, another one-day butterfly. We just did it on just Friday. That did well. So far, these trades have done well, but our forecast on the marketplace is there's just not a lot that's been going on. Still feel the same way until we get into the second quarter earnings reports. You got the doldrums of the holiday that are ahead of us, and I just would like to be neutral on the marketplace, and this is the way that I'm choosing to do it, is through the butterfly, using very short-term option contracts. And our outlook would be that we're going to put this on for around $5. It's trading at 505 at the midpoint right now. I'd leave it in at 5, let it work a little bit. And then if we can double on the trade, we'd want to get out. On the downside, if we see the market go to our wings, we might adjust the trade. You could even sell the trade and just close it and get out. You'd probably be down about half. It'd be trading somewhere around $2.50 or so if it happened today. And if not, I can actually roll this into a short spread. And if I do that with this trade, I will send out a tweet. My handle is @BrianOverby. I don't know if you call it an X now. Tweet just sounds a lot better. But that is what I would do if I made an adjustment on this trade. Now, it's much more feasible to adjust a 2.5-day trade, which we have in this S&P 500 index trade, as opposed to the one-day trade that we looked at on Friday. So that's our scenario. So here we go. We're looking at the July 3rd. Note over here that inside the Tradier Pro software, it's highlighting that you are in the July 3rd. You have the box around this. We're on this side of the chain, so we're talking about calls. This side of the chain is puts. And we're buying one of the 54.35 strike calls, selling two of the 54.60 strike calls, and buying one of the 54.85 strike calls. We're doing this for a net debit to the account of $5 for every 1x2x1 butterfly. That would be a midpoint fill. So this would be a fairly good fill. And don't forget to subtract any commissions or add any commissions to your net debit on the trade as far as your profit and loss is concerned. And we're sending that to the trading floor. And that will be our paper trade for the next 2 days. I will put this position on inside my own account, and I will watch it and trade it. Give me something to look at for the next couple of days. Thanks for stopping. I do see a comment. So here we go. Let's zoom back out. Does the market close half day on this Wednesday? This Wednesday, I don't think it's a half day. I think it's a full day. The only really day they do the half day is the Friday after Thanksgiving. So this Wednesday will be a full day off on the marketplace for the 4th of July. And that's just the normal way that they will trade it. I assumed that from all my years of trading, usually the 4th of July is a complete day off. But I guess you can Google it and check it. But I'm 99% sure that it's an entire day. All right. Thanks for stopping, and we will see you. Any other questions? If you have any other questions, let me know. All right. And on this Wednesday, you're talking about the Wednesday before the 4th. Okay. Not Thursday is the 4th. Good Friday. So I am actually looking at it right now. So the market holiday for the 4th of July, yeah, there is no half day on Wednesday. It is just Thursday. It's all day. And oh, it looks like Friday is going to be oh, that's in 2025. So each market will close early at 1 p.m. Yes, you are right. We will have a half day close on the Wednesday prior to the 4th of July. So we basically have 2 full days for this to trade. So on that Wednesday, the market will be closed early. So there you go. Excellent. At 1 p.m. Thank you, Anthony, for pointing that out. And that's it. Anything else, Anthony, that you want to bring up or anybody else out there? So we got a half a day on Wednesday to trade this. So we want to make sure that we're close. And one of the biggest things too with the SPX, just want to highlight this, is that it is cash settled. So you can ride it to the close if you would like. I don't mind that in the S&P 500 index, and this is much different than doing the trade inside the SPYs. So very important. Yes, this Wednesday it's closed at 1 p.m. Thank you for stopping by. We'll see you this Wednesday. I will be doing a live version of Options Guide TV Wednesday morning at 11 a.m. Eastern Time, and we will be looking at this trade. Thanks for stopping in, and we will see you this Wednesday for the next edition of Options Guide TV. Thanks for coming.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.